Hey everyone, this is Mike with Rags to Riches Trading. So the market was down today. It's been down a lot over the last 3 days because of the Fed. So I think people are starting to finally realize that they're serious about keeping interest rates high, and of course that's really taken a bite out of the stock market. So one stock I noticed was down a lot today was Dollar General. So they're down to $110, and I was actually looking at this stock back here. Around before earnings around May, and I just thought I didn't see the value there. Just based on the numbers, it looked like it was overvalued to me, and boom, had earnings, got absolutely crushed. But even then, before earnings again in August, still didn't look like it had value, it looked like it was overvalued in my opinion. So, and I guess the market kind of thought the same thing after the report. Down again. So now they're down to $110. So I think it's a good time to take a look and see if it's worth, like writing a put against this. So let's take a look at earnings here. Quick run through. So you see the PE or the estimate is around $8 to $9 a share. So PE is 13, 14. So that's maybe the high end of the range for a Dollar General. So if we just do some quick math, we could say, the fair value is between 8, right? If earnings are $8, you do 8 times 10 is 80, and then 8 times 15, whatever that number is, it's a little bit higher. So I think we're at the top of that range right now. So let's look at the financials of Dollar General. This pop-up's pretty annoying, but let's look at the income statement here. So we can see that they are growing revenues, so that's always a good sign. Gross profit, they're growing gross profit, that's a good sign. And income is going up, or kind of maybe going up slightly. Let's take a look at the balance sheet. So balance sheet, cash, looks like they had about $350 million in cash on hand. Let's take a look at the debt. I always like to look at the debt, long-term debt. So they had about $3 billion, $4 billion, going up here to around, so they have around $7 billion in debt and total liabilities because they have a lot of capital leases. I think these are rents for the stores. They're around 20 to 23 billion and 24 in their last report. So debt is not low. And let's take a look at cash flow. Cash flow, right? It's a more realistic kind of view of how a company's doing. Because with regular earnings, you can hide things. Can't really do it on the cash flow statement. So net income, growing, and the cash flow 2 billion, 2 billion, 3.8, 2.8, and then kind of poor numbers over here. And if we look at free cash flow, is your cash from operations less your capital expenditures. So these years look pretty good here. But things kind of go off the rails here, so they're not really bringing in a lot more cash than they are spending on CapEx. And it looks like what's driving that is these big inventory numbers. So maybe I'm a little less worried because they're, it's an inventory thing, so that thing should fix itself. Look, inventory is going up year after year after year. How can it, keep doing that? Otherwise, they, at some point this has to flip. I think when that flips, that cash flow number may look a little better. But I think I'm going to pass on this, not do anything right now. Maybe we'll see if it goes down to 105 or 100 and take a look at it again. But to me, the cash flow of, $2 billion, $1 billion versus the debt of, $7 billion in long-term debt. I don't know. The risk reward isn't looking that great to me at this point in time, but who knows? Maybe we'll see it sell off further, and it could present an opportunity. All right, thank you. Bye.